Good morning, viewers. Once again welcome to Sunday Rubenga Akoni online tutorial. And this morning, we want to look at audit assurance and forensic AAF. And our topic for this morning is the concept and need for assurance, part 1. So in this lecture, we shall be looking at the meaning and objective of an audit. We will also look at the concept of stewardship, agency, and accountability. Then we will look at level of assurance before we finally wrap the lecture up with elements of an assurance engagement. So, without any cause for delay, I want to start from the definition of an audit. An audit may be defined as the official examination of the account or accounting systems of a company by an auditor. So, if you look at the definition, say examination of the account or accounting system. If you look there, for a particular company, there are a number of accounting systems. For example, there could be trade payable system, trade receivables, payroll system, and so on and so forth. Everything that is now summarized to make the financial statement. So those are what the auditor will come around to come and examine at the end of a particular year in order to express his opinion. And if you see they say by an auditor, that is in a general context, because auditor can be categorized into two. For example, we have internal auditor and external auditor. Internal auditors are staff of the company. They are always employed by the company and they receive salary as remuneration. External auditor, on the other hand, are they are mandated by the law to carry out the audit of the financial statement of the company. They are not employees of the company, so they don't collect salary. They collect what is known as audit fee. So in the context of a statutory audit, we can now say an audit is an official examination of the account or accounting system of a company by an external auditor. So by a statutory audit, I mean an audit that is required by law. So now move to objective of an audit. So when an auditor come to audit a company financial statement, what is he actually looking for? So what is the objective he is trying to achieve? The objective is to express an opinion as to whether the financial statements have been prepared in accordance with an applicable financial reporting framework, and to state whether or not the financial statements give a true and fair view of the performance and position of the company. So when we say applicable financial reporting framework, they are always in two categories: the legislation or the law of a particular country in which the company is residing is one. In Nigeria, we have, so for applicable financial reporting framework, in Nigeria we have Company and Allied Matter Act of 2020. Then we have Bank and Other Financial Institution Act of 2020 as well. We also have the Financial Reporting Council of Nigeria Act of 2011. Those are the legislation that is governing the preparation of financial statement, the auditing of financial statement, the preparation of financial statement in Nigeria. Then we now also talk about accounting standard. So accounting standard can either be international standard on auditing, international accounting standard, or international financial reporting standard. So these are what make up the applicable financial reporting framework, the legislation and the standard. So that is that about that. Then we also mention here that whether the financial statement give a true and fair view of the performance and the position of the company for a given period. Normally, the financial statement is prepared for a particular year, that is annual account for a complete 1 year. So information about the performance of the financial statement, you can mainly see it in the statement of profit or loss and other comprehensive income. You can also see it in statement of changes in equity, and of course you can as well see it in statement of cash flows, how the company perform during the year. But information about the position of the company as at the year end, normally see that one in statement of financial position, which some other people know as the balance sheet. So now move on now to the concept of stewardship. Concept of stewardship agency and accountability. So from this one, we will see the reason why audit is necessary. In the first instance is that in large company there is usually separation between the ownership and the management of the company. Now the shareholders are the owners of the company, while the directors or management, as you want to call it, see to the management and control of the day-to-day running of the business. So since the owner are not involved in the day-to-day running of the business, they need somebody to watch over the shoulder of the directors, so that to ensure that the directors are acting in their best interest. You get the point? That's why the appointment of an auditor is necessary. So when we say stewardship, the directors are performing stewardship responsibility to the shareholders. They are acting in their best interest, managing their assets for them to ensure that everything about the business goes in the right direction. Then they also act as an agent on behalf
of the shareholders. The general principle of agency state that in a business that involve financial transaction, an agent must act in the best interest of the principal. In this situation, the directors are the agent while the shareholders are their principal. So at the end of each period or periodically, as we may want to say it, the directors will render account, that is, they will be accountable to the shareholders. So by the time they render that account, they normally render it in the form of accountability document, which are the financial statements I have earlier mentioned. We have statement of financial position, we have statement of profit or loss and other comprehensive income. We also have statement of changes in equity, and we also have statement of cash flows. So and the note thereon. So the auditor will now audit it in order to add credibility to the work of the director. So we can represent the simple explanation I have made in a pictorial form. Example, these are directors or management. Directors or management. So they will prepare accountability document, which is the financial statement. So the user of the financial statement are the shareholders, owners. So the auditor now will carry out his audit and prepare an audit report. Audit report prepared by the auditor that will add credibility to the financial statement. So we now move from here to assurance. So we want to look at the meaning of assurance now. Assurance. So assurance may be defined as a strong feeling or confidence about what is right or correct. Assurance may be defined as a strong feeling of confidence about what you perceive or you believe is right. So when we are talking of assurance, the auditor is preparing his report in order to provide the kind of assurance to the shareholders here that the financial statements that have been prepared by the director of management give a true and fair view, so and to a large extent could be relied upon. So we now go from here to levels of assurance. Levels of assurance. The first one here is reasonable assurance. Reasonable assurance. This is a high but not absolute. A high but not absolute assurance provided by the practitioner a high but not absolute assurance provided by the practitioner express in a positive form. A high but not absolute assurance provided by the practitioner expressed in a positive form. For example, in our opinion, the financial statement show a true and fair view. The objective of a statutory audit is always to give a reasonable assurance. Then the second one we have is limited assurance. This is a moderate level of assurance
provided by the practitioner conclusion expressed in a negative form. E.g., based on our review nothing has come to our attention that causes us to believe that the accompanying financial statements has been misstated. The objective of a review is often to give limited assurance. So, lastly, I'll be looking at elements of an assurance engagement. Elements of an assurance engagement. So an assurance engagement provided by practitioner consists of 5 basic elements, and the first one is a 3-party relationship. Comprising one, the practitioner; 2, the responsible party; and the intended users. So those are the 3-party relationship that are involved. The practitioner is the person that will carry out examination on the subject matter prepared by the responsible party for the use of intended users. So in a statutory audit, the accountant or the auditor is the practitioner. The responsible party is the director or the management, while the shareholders are the intended users.
So in some other cases, there could be other users like the tax office or researcher. Therefore, a statutory audit, the primary user is the shareholder. So the number 2 here, second one, is the subject matter. So this is the data that is prepared by the responsible party to be examined by the practitioner in the context of a statutory audit. This will be the financial statement. Then the third one is the suitable criteria. Suitable criteria are the rules which the financial statement will be placed side by side with, to know whether they have been prepared in accordance with the applicable financial reporting framework. We have mentioned them earlier, so and I'm going to, for the sake of emphasis, I'm going to mention them again. We have CAMA 2020, BOFIA 2020, Financial Reporting Council of Nigeria Act 2011, then we have ISA, International Standard on Auditing, we have International Accounting Standard, we have International Financial Reporting Standard. So these are the stable criteria. Then the fourth one is the assurance evidence. Assurance evidence. So evidence is any information that the auditor or the practitioner gathered and depend on to arrive at his conclusion to form his audit opinion. It could be in the company accounting system, and they could come from outside the company accounting system, like from bank, from the trade receipts, the debtors, and so on and so forth.